Hello and welcome to Navigating the Waters. We're joined again by our fabulous host, CEO and founder of River VC, Stephanie McKinney.
Hello, good. How are you?
Yeah, I'm good, thank you. I'm really good. Weeks are flying now, aren't they?
Oh my gosh, I can't believe we are already in May. At the end of May. It's ridiculous. We're almost 6 months in.
Scary, isn't it? I wake up and go, where did that go? Where did the year get to? But I guess that's the thing with life, isn't it? It kind of keeps moving forward, whether we like it or not.
Exactly. I mean, this whole year has been crazy with the beginning being rushed and then the end. Like right now, it just feels like it's kind of slowed down, but at the same time, it's not stopping. So quarter 2 and quarter 3 are going to hit us in the head.
So in our last episode, you were taking us through a high level convertible instruments. My head is full blown. So I'm really looking forward to this session because I'm really going to be able to help us understand it even more as we delve into it more detail.
Yes, they are very tricky, and I am not an expert. I'm not a financial advisor, nor am I a lawyer. So what I'm telling everyone is what I have learned, and the knowledge that I'm trying to give you is what I have accumulated over the years. So with that being said, there are 2 types of convertible instruments. That is when you're doing them early on in your pre-seed and seed round. There is the convertible note that we talked about, and there is a safe. So I want to dive more into depth on that document itself. So with a convertible instrument, which is both of them, it's simple, it's faster, it's quicker, it's promising your investors favorable terms for the future. So if you were to invest early on, 70% of startups don't make it. So it's saying, hey, we really value you and we want to give you the best discount, the best rate later on. And we'll go into the details of that. But right now, let's dive into convertible notes. So that is the loan. That is where you're delaying how much your company is valuated at, how much your company is worth in shares, by saying, we don't know yet, but we're going to give you the best rate possible. And the valuations are speculated at this time because you don't have your MVP built, you don't have your revenue, you're not where you want to be with your team or your company. So you're saying, if we were at a $5 million company, this is what we would love to see transition into shares, price per share. So the convertible note is where the investor invests in a company without really knowing its true valuation. And it's a loan. It is saying, you'll give us money now, we'll give you a discount rate, and then instead of converting it back to money, it's converted into shares in your company at a certain price. So the breakdown of that is you have interest rates, you have a maturity date, which is like your expiration date when you have to cash that document in. You have a valuation cap or a discount rate. So with this, a lot of times it's easy to, well, do you have any questions so far? I don't want to keep going and maybe something went over your head.
I think I'm getting there. Okay. What you're basically saying is when you're not ready yet to say, I know that my business is valued at this, but I believe in valued it, that some people like that. You're doing the notes.
Yeah, exactly. While you're being evaluated.
Hello and welcome to Navigating the Waters. We're joined again by our fabulous host, CEO and founder of River VC, Stephanie McKinney.
Hello, good. How are you?
Yeah, I'm good, thank you. I'm really good. Weeks are flying now, aren't they?
Oh my gosh, I can't believe we are already in May. At the end of May. It's ridiculous. We're almost 6 months in.
Scary, isn't it? And I wake up and go, where did that go? Where did the year get to? But I guess that's the thing with life, isn't it? It kind of keeps moving forward, whether we like it or not.
Exactly. I mean, this whole year has been crazy with the beginning being rushed and then the end. Like right now, it just feels like it's kind of slowed down, but at the same time, it's not stopping. So quarter 2 and quarter 3 are going to hit us in the head.
So in our last episode, you take us through a high level convertible instruments. My head is full blown. So I'm really looking forward to this session because I'm really going to be able to help us understand even more as we delve into it more detail.
Yes, they are very tricky, and I am not an expert. I'm not a financial advisor, nor am I a lawyer. So what I'm telling everyone is what I have learned, and the knowledge that I'm trying to give you is what I have accumulated over the years. So with that being said, there are 2 types of convertible instruments. That is when you're doing them early on in your pre-seed and seed round. There is the convertible note that we talked about, and there is a safe. So I want to dive more into depth on that document itself. So with a convertible instrument, which is both of them, it's simple, it's faster, it's quicker, it's promising your investors favorable terms for the future. So if you were to invest early on, 70% of startups don't make it. So it's saying, hey, we really value you and we want to give you the best discount, the best rate later on. And we'll go into the details of that. But right now, let's dive into convertible notes. So that is the loan. That is where you're delaying how much your company is valuated at, how much your company is worth in shares, by saying, we don't know yet, but we're going to give you the best rate possible. And evaluations are speculated at this time because you don't have your MVP built, you don't have your revenue, you're not where you want to be with your team or your company. So you're saying, if we were at a $5 million company, this is what we would love to see transition into shares, price per share. So the convertible note is where the investor invests in a company without really knowing its true valuation. And it's a loan. It is saying, you'll give us money now, we'll give you a discount rate, and then instead of converting it back to money, it's converted into shares in your company at a certain price. So the breakdown of that is you have interest rates, you have a maturity date, which is like your expiration date, when you have to cash that document in. You have a valuation cap or a discount rate. So with this, a lot of times it's easy to, well, do you have any questions so far? I don't want to keep going and maybe something went over your head.
I think I'm getting there. Okay. What you basically saying is, when you're not ready yet to say, I know that my business is valued at this, but I believe in valued it, that some people like that. You're doing the notes.
Yeah, exactly. While you're being evaluated,
I'll edit that bit, I'm sorry.
That's okay. I thought you wanted me to keep going, but you kept trying, so I wanted.
Oh, yeah, those people. I'll go back to
go back to it.
And then we can edit. So on a convertible note, what we're saying is we're not ready yet to really understand the valuation of our business, but we've got an aspiration in mind. If it does what we expect it to do, if we get our MVP, the revenues come in, we expect the business to be worth, say, $5 billion. And therefore, the investor almost agrees that that's likely, then they'll sign up to kind of confirm to say, if that were to happen, for the money I lend you, you can give me X shares.
Exactly. Yes. It's a way to say, we think our company's here, and they agree on it. I mean, you can talk back and forth, and then, but the valuation is very, and we're going to dive into that in another episode. So it's not something that I'm just going to throw that term out there and leave you, but it's how much how much revenue you have, how much money you're taking in, and it can also be very tricky and early on with safes, that other convertible instrument document, because they need to know your pre-money valuation or your post-money valuation, which is where let's say your company is a $4 million company. So pre-money valuation is $4 million. The raise is $1 million. You're getting $1 million. And then your post-money valuation is $5 million. The pre-money plus your raise. And I would love to really, really dive into this, but I'll give you, that's my little example. It's if you invest that $1 million in a pre-money, which means that at that $4 million, you own 20% of the company. But if you do that on a post-money, you own 25% of the company. So it varies in how much percent ownership your investors are going to get, which is why it's something that really needs to be talked about when you're raising your safe rounds.
Okay, so obviously there's a clear implication on which one of those things and how much business will give it away, and equally investors in how much they're getting.
Right. Yeah, it's exactly. You're trying to get, the best deal early on, because when they do raise their priced rounds, which is where other investors' monies go straight to the price per share and they get that shares, you want to make sure that the people that invested you when it was just a little seed get the best valuation, get the best cap, and get the best out of their investment. Because if you don't have these things that I talked about, like the interest rate, the discount, the valuation cap, then your person's investment is going to be a slither in that pie, rather than them holding on and not getting as diluted as they do when you raise those other rounds.
Okay, so it's clearly important when we're thinking about how we protect our investor, particularly in those early stages, because they've been with us at the tough bits, haven't they? As we've just moved from bootstrapping to finally getting somebody else to kind of come on our journey with us and say, yeah, actually, I think you've got this. I think this is a great idea and I want to be along for the journey. It's about how we safeguard the risk that they took, because to all intents and purposes, they've taken a greater risk because they got in at an earlier stage. Would that be fair?
Absolutely. They did take that early risk, and 70% of companies don't make it. So they really want to, if they do make it and they do succeed, they want to make sure that those investors earlier on, get their money's worth, get their time worth, that they did invest in it when it was just a little tiny, startup.
So then, once you've gone through those, is knowing all of that an important part of putting into your pitch deck for future rounds, so that they can see how the company is already structured and how it's likely to be structured in future rounds, or does that come later?
That is something definitely to keep track of, especially as the founder, as you're growing, as you're raising new rounds. A lot of people, they ask during that to see your financials. And then that you can show, how the company would be broken up if you raised X amount of money later on. But I've never seen it myself in a pitch deck, but that would be something that I've seen in financials.
Okay, that makes more sense, because I guess if not, it gets very confusing. Cause the pitch deck really is about the overall story about the business, isn't it, and the company. So things like that, which are important, and the detailed structure, they really come in the financial pack that supports pitch deck. Would that be fair?
Yes. And you want to make sure that they sign that NDA, because if they're like, oh, well, Stephanie McKinney's company X is only giving out 5% of the shares, then no one else would want to invest in it if it's not a good deal. So you really want to make sure that you're secure, your company's secure, while you're showing how much you're giving away in your company. And I've gotten a couple of questions about that. Is, okay, you're the CEO and you have a partner and you guys are giving away your percent ownership. And that is true. But you're not giving away your share amount. So let's say you and I are in a startup together and we're 50-50 right now, which means that we have 50% of the shares. And usually this is done with a C corporation, not an S corporation, so you can divvy up the shares later on. And our company is valuated at, let's go big, let's go $10 million. So we have $5 million shares, right? Because we're 50-50. The company issues new shares as we do our next rounds. We're not diluting our share percent. We're diluting our percent in the company. So let's say we're raising our first round at $1 million in our pre-seed, and an investor wants 20% of our company. The percent and the valuation depends on what you and I agree with, and our team, our space, how gung-ho are we, how committed are we. So we don't have a true valuation yet. But if we do a pre-money for $4 million, and then they invest $1 million, then our post-money valuation is $5 million, which means that I have 5 million shares, remember from the very beginning, and our $10 million pot. You have 5 million shares. And then we issued our new investor who wants 20%, 2.5 million shares, which brings us to a total of 12.5 million shares. And that price per round is converted into 40 cents a shares because that person wanted 20%. So this is where it's crazy, and I have to take notes and be meticulous when I'm reading these documents because it's very, like I said, you need a lawyer, but you also don't want to pay that lawyer fee earlier on. So knowing the terms, knowing the terminology, evaluation, post-money, pre-money revenue, and safes is very important. So I want to, nail the hammer on the head that the founders don't give up their shares. They give up their percent ownership. And in that example, we still had our 5 million from the beginning. We just now have 40% of the company, and that new investor has 20.
Okay, that makes total sense, but I can see why you have to take meticulous, can't say it, but I can see it, meticulous notes, because that is quite complex, isn't it? Working through. So I've got my 5 million, you've got your 5 million, but our new investor who gets 20%, they've got 2.5 million. So actually, the pot of shares that started off at 10 million is now 12.5 million. And therefore, there is to your point, there is a dilution in the percentage of the business that we own, but we own the same number of shares. We're not giving the shares away to somebody else. And I think we could do an entire session just on valuations and some of those terms. And I know you very kindly, following each of these, always provide us with a blog as well with a bit more information about some of those terms, because you've explained it so beautifully, but they feel complex on that first run through, don't they? And I think, as we've discussed before, that is one of the things that often puts off, particularly female founders looking for investment, is the fear of some of that terminology and fearing that you're not going to know what it really means. A great point about obviously not wanting to incur the legal costs too soon, but you still want to have an idea of what it is that you're getting into, what you're getting up against.
Right, exactly. And it's really important that you're not the only one out there that is doing this. And there's other resources. There's, like you said, the blog that we have. There's Navigating the Waters. There's you can message me directly with your questions. It's a lot. It's a lot, and it's early on. I mean, we're talking pre-seed, seed rounds. You haven't even built your MVP yet, which is a whole nother headache. So it's very, like I said, meticulous, and it has its own structure. It's a whole new job. And unfortunately, a lot of times founders hate raising money because it's taking them away from their goal, from their company. And they have to stop, and then they have to learn about all this stuff while trying to still maintain, let's say you're building an app. You're trying to build an app, and now you have to stop and learn what post-money and pre-money valuation is. So I hope that Navigating the Waters has taken a little bit of pressure off of those founders' shoulders by breaking down this terminology, so you don't have to do 3 hours of research or hire a lawyer for $500 an hour, and you are able to come into the meeting, come into the pitch deck, and be informed and be known that, like we did last episode, you don't need to know it all, but some stuff you do need to have some understanding of. And that is why I would love to continue to break down, convertible notes and what they are. With that, we talked about interest rate. I'm pretty sure everyone has known what a loan is and what an interest rate is. We did a maturity date, which is your expiration. So with the convertible note, you can put your maturity date when you raise a certain amount. So let's say, I want to cash in when I finally raise $5 million. That's where I think my company is worth, and that's where I'm ready to give away that percent ownership. Because once you convert, they get your shares and they get that piece of the pie. You have a valuation cap and a discount rate in your convertible note. So I'm going to dive into these a little bit later in an episode, but let's say that an investor is on a convertible note at $1 million. The maturity date is 24 months, so 2 years. I think I can raise this in 2 years. The interest rate is usually between 2 to 7%. If anything higher, then you have a good deal, but 2 to 7%, and you have no valuation cap and no discount rate. That means that when you raise later on, your investment is going to be diluted because it's a bigger round or they're raising a certain amount. So your price per share is going to be not worth your investment in the beginning. So a discount rate is defined as a discount on a valuation cap that future investors are getting. So if investor Sally is $1 million on a convertible note with the interest rate of 5% and a discount rate of 20, that's not the best deal, but it is a good percent ownership or percent shares. And if you invest with a 5% on a 20% discount, you get a valuation cap of, let's say, 10 million, no matter what. So if you raise 20 million and a 10 million round, you still get that better deal, that 10 million round. But it's very complicated, and I just feel like I'm throwing numbers at you, and it's not accumulating to anything tangible. But it's better to give your investor the best deal possible, and that is through a valuation cap or a discount rate.
Okay, that makes sense. This is what you sorry. What you're basically saying is you're going to help to safeguard the future by looking at it right now. So saying we've got these caps, so you're investing in early, we're going to be looking at how you move that around later on so that you're safeguarding their investment and also understanding your own. And you're right, there's a lot of numbers in this. And maybe one of the things we could do in the future one, which for anybody listening, it would have to also be read the blog. For people that join us and watch, then maybe we could share some slides that just bring that to life and help people work through a worked example, which you've done so eloquently, but it's sometimes for those visual ones amongst us, that ability to be able to see it, isn't it? Which I know you'll put in the blog, but that might be helpful when we really dig into those differences and those rounds around discounted and all of those parts, if we could pull that to life with something that people can see as well.
Absolutely. I am a visual learner. I think holding something tangible, which is why when I watch other videos or I listen to other podcasts, I'm always have a notepad right next to me, a legal pad. I'm always writing notes. I'm always making sure, okay, how did they get 4% per share if that person has 20%? But it is something that I would rather throw these numbers at you now and get you scared than have you go into the investor pitch deck meeting and be like, I don't know. So I would rather, do another episode where we do break down the convertible notes and the price per share and go further down into that nitty-gritty detail of it.
That would be great, because I think you've given us so much there. What I love is each of these build on the previous one. So you take us to a high level of one, and then the next time you dig into the detail of that, whilst getting us ready for the next high level one that comes as soon as we've learned that one. And your point before, that you're doing this so that we don't have to spend hours and hours and hours learning it and working out how it goes, but actually are able to build that confidence. I think what would be great is in those next ones is to be able to break each of those down in a little bit more detail. The one thing I suddenly realised we've mentioned, I don't know if we said what it was, very rightly pointed out earlier in today's session that you need to make sure you've got your NDA in place, your non-disclosure agreement. I just wanted to make sure we shared with people that it's a non-disclosure agreement so they knew what it was that they were looking to do, because that's vital, isn't it, that we get those out there before we start sharing pertinent information about our business, our idea, our vision for the future.
Exactly. And that's why I love navigating the waters, because we're creating that atmosphere where you can go back and say, Stephanie, you didn't kind of say what NDA is, or you need to go into a little bit more detail about a discount rate. And that's why I want you to ask these questions for the listeners. I want you to message me. I've gotten a couple of emails saying, what do you mean by convertible note? What is the difference between a safe and a note? And I love that. I love the feedback that we're getting. And I would hope that whoever's listening, that you have feedback or you have clarification that you need and you need help a little bit, or you have some piece that you want to add to it. Maybe you're like, oh, well, evaluation kind of had worked for me in the past like this. That's something that I value too, because I'm also learning. We're all also learning. And I would love to create that environment through navigating the waters where people feel comfortable to come back and say, I watched your episode 6 and we really need to dive into the necessities of an interest rate, because I did just briefly skate over it, as we all know what a loan is. So I think that is why navigating the waters here is to empower our listeners to ask these questions, to have the knowledge and the tools to go into these hard meetings and be confident. We talked about that in a couple episodes. It's confidence. It's, you don't have all the answers, but you do have the tools, you do have the resources. And I hope navigating the waters is something that people continue to use and continue to ask feedback and ask their questions.
I love it. I'm learning so much, and I love that we are creating that community, that safe space where people can go, oh, I didn't know that, or can I know a bit more about this, or actually I've got this that I'd like to add to it. So I know you always tell us this at the end of it, but we do want people to share with us, don't we? What do you think? What are your thoughts? What would you like to see Stephanie help us unpack next? What's the burning question that you've got on your investment journey that we can hopefully, through Stephanie's knowledge and experience, help unpack and demystify so that we can be empowered to feel able to articulate ourselves appropriately in those meetings and to be able to get our points over and to make that change on the percentage of investment that's going to female-founded businesses.
Exactly. I want to get that 3% up, and in that 3%, it's minute for African American, for someone from Europe. It's so small, and our 3% needs to grow. It needs to grow, and there's VCs out there. There's River. There's Navigating the Waters that are equipping these women to become the next big unicorn, which is someone that blows the cap off of it. Like Uber, how it became a multi-million billion-dollar company. That's a unicorn. I want to explain that. But female founders, females we're smart, we're driven, we're passionate, we're committed. So that number is just so low and so unbelievable.
It's so true. I think they've shown that female-founded organisations in the last 2 years have outperformed male-founded ones by nearly 50%. And a lot of that is because neuroscientifically, we're more hardwired into that emotional element of business, not just the IQ element of business. But the beauty of what you guys are doing is about helping us find our strength and finding that power. So I've thoroughly enjoyed today. I've learned loads. I can't wait to delve into what is a unicorn, because it sounds like it's not what my little girl thinks is a unicorn. But I think that will be great, and also to get to more detail. So thank you so much for letting me be part of the Navigating the Waters journey and for helping share this way of creating that community to help other female founders like me find their feet.
Thank you. I really appreciate all your feedback. And, it is important to be well-rounded and diverse and inclusive in all of that you do. And I think that River and your company really amplify that and try to make other people understand what we're doing. But with that, I would like to, I don't think we touched on safes as much as we could have. So I wanted to just briefly go over a SAFE, which is still a convertible instrument. It is not debt. It does not have interest rate. It does not have a maturity date. It does, however, have those valuation caps and discount rates that we're going to talk about later on in the following episodes. But SAFE instruments, they do convert on stock in the future rounds. So it does say, give us your money now, and then later on we'll convert. And that is done at the next round. So you're not waiting on that maturity date. It's done when you raise your next round. So they are simpler. They're about 5 pages. They're easy to read. There's a template. They were created in 2013 by Y Combinator. So there's templates out there that you can Google and look up and then just kind of fill in. But I am not a financial advisor or a lawyer, so these are all knowledge that I have been given that I would love to pass on to my listeners. And for my listeners, if you guys have any questions, comments, or concerns, or you want to share your story on navigating the waters, I would love to host you. I would love to answer your questions. My information is down below, and I hope you subscribe for future podcasts.
Amazing, as always. Thank you so much. Until next time.
Thank you, Kim.